Stop scrolling for a second because what happened this week in the currency markets is the kind of move that looks like noise on a chart right up until the day you realize it was the signal everyone missed. We just watched the US dollar post its steepest weekly gain in over a year, 1 full year. And it didn't happen because of some random technical breakout. It happened because the world suddenly remembered what the dollar actually is when everything else starts shaking. At the same time, JPMorgan dropped a forecast revision that goes against everything Wall Street has been telling you for the past 18 months. No more rate cuts, not this year, not next year, and potentially rate hikes coming in 2027. While you were focused on whether the Fed might cut once or twice, the smart money was quietly repositioning for a world where the cuts never come at all. And right in the middle of all this, we've got a geopolitical crisis that most people are drastically underestimating. The Iran situation isn't just a headline, it's a direct threat to the energy supply chain that feeds the entire global economy. And when energy supply gets threatened, everything changes. Inflation changes, Fed policy changes, the dollar changes, your portfolio changes. If you're holding dollars, if you're thinking about currency exposure, if you're in stocks or bonds or real estate or anything that depends on where interest rates go next, this is the video you needed today, because I'm going to walk you through what the dollar's historic surge actually signals beneath the surface, what JPMorgan is seeing that made them revise their entire Fed outlook, why the Iran crisis matters way more than a temporary oil spike, and what I'm watching this weekend that could either trigger a brutal Monday morning gap or set up one of the cleanest opportunities we've seen in months. And then near the end, I'll explain the one mistake that wipes people out when geopolitical risk collides with monetary policy shifts, even when they eventually get the direction right, and how the biggest institutions use that chaos like a vacuum to accumulate positions while everyone else panics. Now, before we jump in, quick favor. My channel stats are loud and clear. A huge chunk of you who watch these videos regularly still haven't subscribed, and look, I get it. You can watch without subscribing. But if you're getting even a little value from this breakdown, help me out by hitting subscribe. We're building something special here at Market Acme, and your click actually matters more than you think for helping this content reach more people who need to see it. Also, we're now posting members exclusive videos on a regular basis, and this isn't recycled content. A dedicated team is working behind the scenes to build these deep dive updates only for you, our special members, and the Market Acme family. If you want in, click the join button right now or use the link in the description. All right, let's get into it. What happened this week wasn't just volatility, it was a message. The dollar surged to its strongest weekly performance in a year, and it did so while everything else looked uncertain. That's not a coincidence. That's the market telling you something important about how capital flows when fear enters the system. Now, here's the part most people miss. When the dollar rallies like this, you can't just look at the DXY chart and say, oh, the dollar is strong. You have to look at why it's strong and what that strength is pricing in. Because there's dollar strength that comes from economic dominance, and there's dollar strength that comes from fear. And those two types of strength have very different implications for what comes next. This week's move was fear-driven, pure and simple. Foreign exchange desks are trading with one eye on the price screen and one eye fixed squarely on the Strait of Hormuz. And when professional traders start positioning for energy supply disruptions rather than trading crude directionally, the psychology of the market has shifted from price discovery to survival mode. Think about that. The people who do this for a living aren't trying to make money on oil right now. They're trying to not lose money if something breaks. They're buying protection. They're hedging weekend risk. They're refusing to run large short dollar positions while the geopolitical fuse is still burning. That tells you everything about where we are. Now let's connect the dollar move to what JPMorgan just announced, because these two stories are actually one story. JPMorgan revised their Fed forecast this week, and what they said should stop you in your tracks. According to the Bank of Korea's New York office report, JPMorgan has concluded that the rate cutting cycle ended in December. Not paused. Ended. They don't expect any rate cuts this year. They don't expect any rate cuts in 2026. And they're forecasting that the Fed's next move could actually be a rate hike in 2027, potentially taking rates to 4%. Now, why would the world's most powerful bank make a call like that when literally every other major institution is still expecting cuts? Let's look at the divergence. Citi expects 3 rate cuts. TD Cowen expects 3 rate cuts. Barclays expects 2. Bank of America expects 2. Goldman Sachs expects 2. Morgan Stanley expects 2. Nomura expects 2. Wells Fargo expects 2. Deutsche Bank expects 1. That's 8 major banks on one side of the trade expecting cuts. And JPMorgan standing completely alone saying no cuts are coming and hikes might follow. When you see a divergence that extreme, you have to pay attention. Because one of two things is true. Either JPMorgan is dramatically wrong and they're about to look foolish, or JPMorgan is seeing something in the data, something in the geopolitical landscape, something in the inflation trajectory that the other banks aren't willing to say out loud yet. And here's where the Iran crisis connects everything. The reason JPMorgan revised their forecast isn't random. It's directly tied to what's happening in the Middle East. The ongoing US-Iran conflict has resurfaced inflation concerns in a way that changes the Fed's calculus entirely. Because if you understand one thing about the Federal Reserve, understand this. They will tolerate a lot of economic pain to maintain credibility on inflation. They watched what happened in the 1970s when the Fed lost that credibility. They will not let it happen again. So when you have a geopolitical situation that threatens to spike energy prices, and energy prices feed directly into inflation, and inflation is already running above the Fed's target, you get a scenario where cutting rates becomes almost impossible. The Fed can't cut into rising inflation without destroying their credibility, and JPMorgan is betting that this is exactly the trap the Fed finds itself in. Now let me walk you through the mechanics, because this is where the story gets spicy. Right now, every additional day that shipments through the Strait of Hormuz are disrupted tightens the spigot feeding the global energy system. We're talking about one of the most critical choke points in the world for oil supply. And when that choke point gets threatened, the ripple effects spread everywhere. Oil prices spike or threaten to spike. Energy costs rise across the economy. Those costs get passed through to consumers. Inflation expectations start to move. The Fed has to respond to those expectations or risk losing control of the narrative. And here's the cruel irony. The dollar rallies because it's the safe haven. But that dollar's strength actually creates its own set of problems for the global economy. It makes dollar-denominated debt more expensive for everyone outside the US. It squeezes emerging markets. It creates feedback loops that make the whole system more fragile. This is why traders on foreign exchange desks right now have one very simple instinct. Do not run large short dollar positions while the geopolitical fuse is still burning. Because if that fuse ignites, you don't want to be caught on the wrong side of a safe haven move that could be violent and fast. Now let me paint you a picture of what's happening behind the scenes, because this is the stuff that never makes headlines but shapes everything. London trading desks are quietly putting on what can only be described as just-in-case oil hedges heading into the weekend. They're not making directional bets on crude going up or down. They're buying protection against a scenario where Monday morning opens with a gap that wipes out anyone who wasn't prepared. When traders start buying protection rather than expressing directional views, the market has shifted its focus from price discovery to supply security. That's a completely different game, and that game has rules that most retail investors don't understand until they've been burned. The rule is simple. When energy risk rises, the dollar tends to keep the high ground. Period. You can have all the fancy analysis in the world about rate differentials and economic data and technical patterns. None of it matters if a headline hits the tape that says oil flows have been disrupted. In that scenario, capital rushes to safety, and safety means dollars. Now here's where it gets interesting for the Fed. There's policy speculation adding another layer of complexity to this whole picture. The U.S. Treasury is already experimenting with ways to ease the energy squeeze. They've floated temporary reprieves that would allow India to purchase Russian crude. They're talking about intervention in oil futures markets. There are discussions about releases from the Strategic Petroleum Reserve. And the most politically explosive idea circulating is a temporary federal gas tax holiday. Now think about the implications of that last one. A gas tax holiday would soften headline inflation numbers in the short term. Cheaper gas at the pump means lower CPI prints. And lower CPI prints theoretically open the door for Fed easing. But here's the twist. That same move has fiscal consequences. It hits government revenue, it could nudge longer-dated Treasury yields higher, and most importantly, it could create an artificial calm that masks the underlying inflation pressure that doesn't go away just because you temporarily reduce the tax on gasoline. In other words, an attempt to cool energy prices could end up reshaping the entire monetary narrative in ways that nobody fully controls. The Fed watches this, the Treasury watches this, and the currency market watches all of them watching each other. Now let's talk about what the Fed itself is signaling, because this matters more than any bank forecast. Later today, Fed Governor Christopher Waller speaks, and here's why that matters. Waller was the lone voice earlier this year calling for a rate cut. He was the dove on the committee. He was the one giving the market hope that relief was coming. But the geopolitical backdrop may have completely shifted his tone. If Waller comes out today and sounds cautious, if he signals that the Fed intends to sit tight while this energy shock works its way through the system, That's a huge tell. That message would lend the dollar additional support by reinforcing the idea that policymakers are not in a hurry to provide accommodation while oil risks remain elevated. And that's the scenario JPMorgan is betting on, a Fed that stays on hold not because the economy is strong, but because they can't cut into an inflation spike without losing credibility. That's a very different situation than cutting because inflation is beaten, and the market implications are completely different. Now let me give you something practical because I know you're wondering what to actually do with this information. The dollar right now is caught between opposing currents. Soft economic data and aggressive energy relief measures could tug the currency lower. But geopolitical uncertainty and cautious central bank rhetoric create a powerful gravitational pull in the opposite direction. For now, that tension looks set to keep the dollar index in a holding pattern. It's the classic market pause where traders wait for the next catalyst rather than forcing a conviction trade. Nobody wants to be the one who makes a big bet right before a headline hits that invalidates everything. But here's the key insight. These holding patterns don't last forever. They build pressure, and when that pressure finally releases, the move can be violent. So what do you watch to know when the pattern breaks? 3 indicators. Write these down. First, watch the 2-year Treasury yield. This is the market's cleanest expression of where short-term rates are heading. When the 2-year yield rises, the market is pricing out cuts and pricing in higher for longer. When it falls, the market is pricing in accommodation. Right now, the 2-year is sending a message that aligns with JPMorgan's view. Cuts are not imminent. Second, watch oil prices and, more importantly, watch oil volatility. When crude itself is stable, but the options market is pricing in huge moves, that tells you traders expect something to break. That's exactly what we're seeing right now. London desks are buying weekend protection even though spot crude isn't spiking. That's fear. That's uncertainty. That's the market saying we don't know what Monday brings. Third, watch the DXY around key technical levels. Right now the dollar has momentum, but momentum can exhaust. If you see the dollar rally into resistance and then fail to hold, that could signal the fear trade is fading. If you see it blast through resistance on heavy volume, that signals the fear trade is intensifying. When all 3 indicators line up, you have a clearer picture. When they conflict, you're in transition, and transition periods are where the volatility lives. Now let me address something that I know is on a lot of your minds. You're watching this and you're wondering, if the dollar is so strong and rates are staying high, what does that mean for my other investments? Here's the honest answer. It depends on what you own and why you own it. If you own assets that were priced for rate cuts, you have a problem. Growth stocks with distant earnings and no current cash flow were valued based on the assumption that money would get cheaper. If money stays expensive, those valuations have to compress. There's no way around the math. If you own long-duration bonds hoping for a Fed pivot, you have a problem. Bonds rally when rates fall. If rates stay flat or go higher, you're stuck holding an asset that isn't doing what you bought it to do. And if inflation stays sticky, the real return on those bonds gets eaten away even if the nominal price holds. If you own real estate with floating rate debt, or you were waiting for mortgage rates to drop before buying, you have to recalibrate your timeline. JPMorgan is saying rates stay elevated through 2026 and might go higher in 2027. That's not a pause. That's a new regime. But here's the flip side. If you've been holding cash and feeling foolish for not being fully invested, you're suddenly in a much better position. Cash earns real yield in a high-rate environment, and patient capital gets rewarded when the forced sellers are finally flushed out. Because make no mistake, there will be forced sellers. When expectations flip this dramatically, people who positioned for the wrong scenario don't just change their minds peacefully. They get squeezed, they get margin called, they get forced to liquidate at the worst possible moment. And that liquidation is exactly what the biggest money in the world waits for. They don't buy when everything is comfortable. They buy when everyone else is panicking. They buy the forced liquidation, and then they wait. That's the game. And if you understand the game, you stop trying to time the exact moment, and you start preparing for multiple scenarios with position sizes you can actually hold. Now let me tell you about the one mistake that wipes people out in situations like this. The mistake is fighting the tape with leverage because you're convinced you know what has to happen. Here's how it goes. You look at the data, you see the economy slowing, you see the labor market cooling. You're convinced the Fed has to cut. It's obvious, it's just math. So you position aggressively, maybe you short the dollar, maybe you load up on rate-sensitive assets, maybe you use leverage because you're so sure you're right. And then the geopolitical headline hits. Oil spikes, inflation expectations jump, the Fed has to stay on hold, and suddenly your obvious trade is underwater. Every day you're bleeding. Every headline makes it worse. And eventually, you can't take the pain anymore. You exit at the worst possible moment, or worse, you get forced out because your leverage couldn't survive the wait. This is why the biggest money in the world never uses maximum leverage on macro bets. They position directionally, but they size it so they can survive being wrong for months or even years if necessary. They don't need perfect timing because their sizing gives them staying power. That's the difference between getting the thesis right and actually making money from the thesis. You have to survive the journey, not just predict the destination. So when you watch this video and you feel the urge to make a big bet based on what JPMorgan said or what the dollar did this week, ask yourself first, can I hold this position through a scenario where I'm early? Can I survive being wrong temporarily? Can I stay solvent and calm while the market does the opposite of what I expect? If the answer is no, you need to resize. Because the market doesn't care about your conviction. The market only cares about your staying power. Now let me talk about what I'm watching this weekend, because this is where it gets real. The weekend is where the risk lives right now. Markets are closed, but geopolitics doesn't take weekends off. The Iran situation could escalate, headlines could hit, and Monday morning could open with gaps that punish anyone who wasn't prepared. This is exactly why London desks are hedging. They know that Friday close to Monday open is a vulnerability, and in the current environment, that vulnerability is elevated. So here's what I'm watching. I'm watching any headlines about the Strait of Hormuz. If shipping gets disrupted, if there's any military action, if the situation escalates in any way, expect the dollar to gap higher and risk assets to gap lower on Monday. I'm watching any statements from Fed officials. Waller speaks today. If he sounds cautious, that's dollar supportive. If he sounds dovish, despite everything, that could create some temporary dollar weakness. But I'd be very surprised if he sounds dovish, given the current backdrop. I'm watching the oil futures market Sunday night when it opens. Crude will tell us before equities do whether something changed over the weekend. If oil gaps higher, prepare for a risk-off Monday. If oil is stable, the market gets a reprieve. And I'm watching positioning data. When the commitment of traders' reports come out, I want to see whether the big money has been adding to dollar longs or whether they're starting to take profit. That tells you whether the move has room to run or whether it's getting exhausted. Now, I want to be crystal clear about something before we go further. I am not a financial advisor. Nothing in this video should be taken as financial advice. I'm sharing my analysis and perspective for educational and entertainment purposes. Your situation is unique, your risk tolerance is unique, your financial goals are unique. Before you make any investment decisions, please consult with a qualified financial professional who understands your specific circumstances. Do your own research, make your own decisions, and never invest money you can't afford to lose. I say that because I care about this community. I've seen too many people get hurt because they treated YouTube videos like financial advice and sized positions they couldn't survive. Don't be that person. Be smart, be disciplined, be humble about what you don't know. Now let me bring this back to the bigger picture because this is where it all connects. What we're witnessing right now is a potential regime change in how markets operate. For the past 15 years, the playbook was simple. When things get scary, the Fed cuts rates and saves everyone. That playbook worked in 2008. It worked in 2020. It created an entire generation of investors who believe the Fed put is real and reliable. But what happens when the Fed can't save you? What happens when inflation constraints prevent them from cutting even when the economy needs help? What happens when geopolitical risk creates inflation pressure at the exact moment the economy is weakening? That's the scenario JPMorgan is describing, and it's a scenario most investors aren't prepared for because they've never lived through it. The last time we had persistent inflation that prevented Fed easing was the 1970s. And the 1970s were brutal for financial assets. Stocks went nowhere for a decade in real terms. Bonds got destroyed. The only things that worked were real assets and commodities. Now, I'm not saying we're going back to the 1970s. The world is different, the Fed is different, the economy is different. But I am saying you need to at least consider the possibility that the rules have changed. Because if the rules have changed and you're still playing by the old rules, you're going to get hurt. That's why I keep emphasizing preparation over prediction. I don't know exactly what the Fed will do. I don't know exactly where the dollar goes next. I don't know whether JPMorgan is right or the other 8 banks are right. But I do know that preparing for multiple scenarios is better than betting everything on one outcome. And that's what separates the people who survive regime changes from the people who get wiped out by them. Now let me ask you a question, and I want you to answer it in the comments. When you see JPMorgan standing alone against 8 other major banks, do you think they're wrong or do you think they're early? Because your instinct here matters more than your analysis. And here's another question. If the Iran situation escalates this weekend, what's your plan? Do you have one, or are you just hoping nothing happens? Drop your thoughts below. I read the comments and I want to see how this community is thinking. Also, quick friendly request, if you're one of the people in this audience who has done well recently, maybe you positioned correctly for dollar strength, maybe you avoided the rate cut trap, maybe you made a smart move that protected your wealth while others were hoping for a pivot that never came. Share your success story in the comments. Even a short note helps motivate others who are still figuring this out. Now remember what I said earlier, check the description after you finish this. You've got bonus links there, including the premium WhatsApp channel and the membership option. And I want to highlight something about membership. We offer members-only videos too. There's a separate team working on those, and they go deeper with extra research, extra data, and more careful scenario building. Those videos are only for premium members, so if you want the deeper layer, the membership link is in the description. And again, if you've been getting value here, please subscribe. Most of the people watching aren't subscribed, and we're growing this community every single day. Help me build Market Acme into something that actually makes a difference for people trying to navigate these insane markets. Now let's close with a reality check that can save you money. The market we're in right now doesn't reward bold prediction. It rewards patience and risk management. It rewards people who position carefully and maintain staying power. It punishes people who swing for the fences based on conviction about what has to happen. Because the thing about geopolitical risk is you never know when it hits. You never know if this weekend is the one where everything changes. You never know if Monday morning brings relief or chaos. And in that environment, the smart money doesn't try to be a hero. The smart money stays protected. The smart money positions for multiple outcomes. The smart money waits for the dust to settle before making aggressive moves. So watch the signals. Watch the dollar. Watch oil. Watch Fed communication. Watch the indicators I gave you. And most importantly, watch your own behavior. Because the market doesn't just test your portfolio, it tests your psychology. And if you can stay disciplined through the noise, you put yourself in the tiny group that doesn't panic when headlines scream and doesn't chase when false relief appears. That group survives. That group compounds over time. That group is what I'm trying to build here at Market Acme. All right, I want to hear from you. Do you think the dollar's rally continues next week, or is this the top? Do you think JPMorgan is right about no rate cuts, or do you think cuts are still coming? And if the Iran situation escalates, how are you prepared? Drop your answers in the comments. Let's build a conversation that helps everyone in this community navigate what's coming. I'll see you in the next one. Stay safe this weekend, and remember, in markets like this, survival is the first priority. Everything else is secondary.